Dollar, euro, franc, or pound are just some of the currencies most of us have had contact with. For example, during trips abroad, currency exchange, online shopping, or taking a bank loan. However, there are many more possibilities. The foreign exchange market, also known as Forex, is the largest and most liquid financial market in the world, with a daily turnover of over $6 trillion US. It is an over-the-counter OTC market, which means it does not have one headquarters or location, such as the New York or London Stock Exchange. It is also popular because it is a market available not only to institutional clients, but to individual clients as well. Forex trading is about buying or selling a currency in a currency pair. Let's take EUR/USD as an example. The currency pair rate should be read as follows. For example, if the EUR/USD rate is 1.0823, then 1 euro is worth 1.0823 US dollars. Contracts for difference allow you to take a position regardless of whether the price of the instrument is rising or falling. When trading CFDs, investors don't actually own the underlying asset, but are simply speculating on whether the price will rise or fall. Let's get back to the EUR/USD example. If a trader believes that the euro will strengthen against the US dollar, or the USD will weaken against the euro, then he or she places a buy order on the EUR/USD currency pair, i.e., takes a long position. As a result, a trade will be opened, which can be profitable when the price of the instrument increases. If, however, the price goes down, then such an order may result in a loss. If, on the other hand, the trader believes that the US dollar will strengthen against the euro, or that the euro will weaken against the US dollar, he or she places an order to sell EUR/USD, i.e., takes a short position. In this case, an order will be opened that can bring profit when the price of the instrument goes down. In such a situation, the more the price decreases, the greater the profit made will be, and the more the price rises, the greater the loss. The most popular currency pairs are EUR/USD, USD/JPY, and GBP/USD. Investors also often turn to local currencies. USD/PLN is popular in Poland, USD/CZK in the Czech Republic, USD/BRL in Brazil, etc. The decision to place an order is made by traders mainly based on fundamental or technical analysis. Monetary policy and macroeconomic data play an important role here, where tracking the publication of macroeconomic reports allows you to assess the prospects for a given currency. It is also worth using technical analysis to interpret the market situation, thanks to which you can forecast the direction of future price movements. Forex CFD trading at XTB is characterized by, among others, high liquidity, access to dozens of currency pairs, trading with leverage, thanks to which both the potential profits and the size of the possible loss are increased, low transaction costs, trading 24 hours a day, 5 days a week, high volatility, the ability to invest in both ups and downs, which means that you can look for investment opportunities regardless of the direction of the price movement. CFDs for currencies can also be an interesting element of portfolio diversification, which is one of the basic principles of risk management in financial markets. The Click and Trade panel is located in both the Market Watch window and the Chart window. All you need to do is specify the size of the transaction and click on the green or red button depending on the direction of the transaction. You can also use the Order window, where you can find more details. The minimum trade size is 0.01 lot, which means that you can freely adjust the trade size to your own investment possibilities. Then just click the green Buy button if you want to place a buy order, or the red Sell button if you want to sell. The foreign exchange market gives investors many opportunities, thanks to which they can build a diversified investment portfolio and manage it in accordance with their own investment strategy.